Now, most of you know Mike Schenk, and you've heard him speak at various seminars, but for those of you who do not know him, Mike is the Deputy Chief Advocacy Officer and Chief Economist for CUNA. It's a big mouthful, Mike. He also happens to serve as board chair of Summit Credit Union in Madison, Wisconsin. Mike has 36 years in the financial services industry and brings to you a wealth of knowledge regarding today's economic outlook. Now, for most of you, this is his 28th year as our featured Fall Forum speaker. So it lets you know that we really enjoy having Mike present at our Fall Forum. So without a further ado, here you go. Here's Mike Schenk. Take it away, Mike.
Thank you, Denise. I'm so happy to be with you today. Very excited to share some of our thoughts on the economic outlook and how we think the economy is likely to influence credit union operations. I'm sure everybody has the same feeling. Wish we could be there in person. It's kind of a bummer that we can't, but probably safe and sorry is better. And hopefully, knock on wood, we'll get together next year in person. I have a pretty full agenda, and it's not going to depart too much from what I've done in the past, which is essentially talk a little bit about the economy, switch gears and look at the consumer sector, how are our members faring in the current environment, and then look at credit union operations for a bit and talk a little bit about what we see as the way forward from an income perspective and operations generally. So the formula is pretty much the same as in years past. And of course, it wouldn't be a fall forum without a pretest, so we will have one of those. But before we dive into the pretest, let me just say that I find that in the current environment, our forecast is a little bit less certain than it has been previously. I've been excited for all of my presentations over the course of the last year or so. And part of the reason for that is that I've been able to say for each presentation that the forecast that we've put together at that point in time was maybe not rosy, but rosier than the previous forecast. And I have to tell you right up front that that's not the case this time. Our current forecast, which we put together mid-September, probably the 17th or so of September, that forecast is less rosy than the forecast that preceded it, the one we put together in June. And that probably doesn't surprise you if you read the paper or you watch TV. You've seen many economists are dialing back their estimates of how the economy will perform. And for the most part, those recalibrations really have a lot to do with, in the first case, the Delta variant and challenges related to that. And by extension, I guess, the other really obvious and growing concern is around supply chain disruptions. And, initially the thought was the supply chain disruptions would be short-lived, and we would get to the back end of those disruptions relatively quickly. And I think the jury is still out on that, of course, but a bit of the data that we're looking at today, real-time data in surveys, gives us pause. It really leads us to the conclusion that those supply chain disruptions may be longer lasting than we originally anticipated. And of course, that has really important implications for economic performance going forward. Generally speaking, in the credit union strategic planning sessions that I've been in over the last year and a half, I can't say that I've seen big changes in strategic direction. And I would say that there are really three core themes that come up in almost every session that I've been in, maybe not all three of them, but these are three very common themes. The first won't surprise you at all. It has to do with digitization and the fact that, the COVID crisis really accelerated and magnified the need for really, I guess, on-time and real-time interactions with members who needed help quickly. And so that is, I would say, front and center, the number one concern. Related to that, I would say most of the discussions in some way, shape, or form revolve around talent management and the HR function, and especially in the last 6 months or so, I've heard even more of that. And then finally, in the realm of value proposition. So I think broadly, those are the concerns I'm hearing credit unions talk about. From an advocacy perspective, our overall concerns have been obviously maintaining the tax exemption, and that is always job one at CUNA. But really, I think the theme that I've probably talked to you in the past about re-regulation comes up all the time. And the fact that policymakers really don't want to talk about regulatory burden. They're not interested in making it easier for financial institutions, and most surprisingly for credit unions, to interact with members. What they're more concerned about is who in terms of groups of people have been, who's been disrupted during the COVID crisis, and what are we doing to get people to the backside of the crisis with as little disruption as possible. So, we've had to shift gears, and I've probably talked about this with you in the not too distant past, but we've really had to shift gears in terms of the way we approach advocacy. Our common narratives around regulatory burden and the costs imposed by regulations and laws just doesn't hack it these days. And so we are much more focused, actually as an organization, CUNA is more focused on making sure that we as a trade association and everything that we do is aligned better with the thing that you do. And what I mean by that is making sure that what we do, not simply from an advocacy perspective, but across the board as a trade association, that we are better focused on improving financial well-being for all, since that is really at the core what you all do on a daily basis. And we found from a policy perspective, from an advocacy perspective, that theme and that narrative really does resonate, and on both sides of the aisle, which is really important, of course, and impactful. We are concentrating on, the folks that have been most disrupted in inner cities and in rural areas throughout the country. And again, building out a narrative that effectively communicates what credit unions are doing to address those really significant concerns. So that sort of lays the groundwork for my current thinking and what I want to cover today. I think it would be really well, I should be careful how I term it. It would be a big mistake not to have a podcast. So without further ado, I would like to invite Joe Bergeron to the stage, and he will work his technical magic to run us through the 2021 Fall Forum pretest. Joe?
Okay, Mike, here we go.
Okay, so I talked a moment ago about economists dialing back their expectations for economic performance. Two examples of that just within the last week or so. Goldman Sachs cut and the IMF slashed estimates for US GDP growth, both for this year and in 2022. And so I'd like you to do your best to characterize their outlooks for GDP growth based on those recalibrations. And so what does GDP look like in those forecasts now that they've been revised? Is it recessionary, very slow growth close to the long run average? And remember, the long run average growth rate in economic performance or GDP is about 2.75%. Above average growth or very fast growth? Which one of those is the best? And I think that there's a way for you to vote. Is that correct, Joe? Can you see what's happening?
Yeah, it should have popped up. Can anybody tell us whether that poll has popped up yet or not?
Yes, it
Allowing
has.
us to submit.
Okay, awesome. Yeah,
I
we
can't-
only,
I can't
so
submit
Mike,
it though, Joe.
one thing that's a little bit different this year is that all of your questions and the multiple choice answers appear in one poll. So
Okay,
I
so
think
we
we're
have to go
seeing,
through the whole test and then look at it? Is that it?
well, we don't have to, but I don't think we're going to see the results of how people voted on each one until we get to the end.
Okay, all right. So let's just go on to the second question then. Pretty straightforward. There have been, actually, this is one of the biggest questions that people ask me about, especially in the last 6 months or so. These large increases that we're seeing in prices, big changes in the consumer price index, are they best characterized as transitory or not? Are they with us for the long haul? And so the question is it transitory, true or false? And the third question, what's the best indicator of prospects for future inflation in the United States? So looking forward, if you're trying to figure out what the future holds, which one of these measures would be the one that you would turn to sort of noodle through the likely course of price changes? And then question 4, in August, the headline unemployment rate was 5.2%. What was the unemployment rate for August 2021 if we adjust for folks that have dropped out of the labor force? So the current, or I shouldn't say the current headline rate is 4.8%, but we only have August data for the adjustment to the labor force. So we're looking at August, and is that adjusted rate higher or lower than the headline rate, and to what extent? If you scroll down, you can make your choices. Question 5, what phrase best describes the consumer sector's aggregate balance sheet today? Never been weaker, appeared to have declined marginally compared to pre-COVID levels, hasn't changed one bit, improved marginally, and never appeared stronger. What does the household sector look like from a financial perspective? Okay, and then according to the Financial Health Network, what percent of American adults are financially unwell? And that is, using their definition, either struggling or just getting by. Is it 1 in 5 people? Is it a third, half, 2/3? Or choice 5? I would not choose choice 5. Okay. The Mortgage Bankers Association just released its September mortgage market forecast a couple weeks ago. And that reflects expectations for 1 to 4 family mortgage originations to change next year, not surprisingly. Compared to this year, how does the MBA see originations changing going forward?
Everybody could mute their microphones. Thank you.
Yeah.
So do you think mortgage originations are going up or down, and then choose a magnitude? And then number 8, the IHS, not HIS, the IHS market forecasts new car sales are going to change in 2022 as well. Again, not surprisingly. Compared to this year, how does IHS see 2022 sales? Higher, lower, and then to what degree? And then 9, Aggregate U.S. Credit Union ROA, net income as a percentage of assets, average assets, in the first half of 2021 would be best characterized as what? The largest negative ROA in the past quarter century, a small negative ROA, break even, small positive ROA, or the largest positive ROA in the past quarter century. And then question number 10, aggregate credit union net worth as a percentage of assets finished last year, or 2019, I should say, at 11.2%. That was sort of the cyclical high on that number. By mid-year 21, the ratio stood at 10%. What will credit union net worth ratios likely be at the end of this year? Be higher or lower than 10%? And you have several choices for that as well. When you're done with all the questions, submit your results.
We should give a few extra seconds for people the final people to
Sure.
be voting. Mike? And I'm only seeing a few changes trickling in for votes. I don't think anybody's still on question 1.
That's good.
Number 1 doesn't seem to be changing anymore. So if there's a couple more. Okay, folks, if you click submit to finalize all your answers, we'll end the poll. And now we're going to share the results, Mike. So they'll probably, appear similarly as far as people scrolling down to see question 1, 2, 3, etc.
Okay. Okay. Recent news. This is the question about revisions to GDP. Both Goldman Sachs and the IMF were reported to have cut their estimates for GDP growth. And I'm happy to report that the correct answer on this question is the one that nobody chose: very fast growth. So in both cases, the GDP estimates that the forecasters published were in fact lower than their previous estimates. But in each case, and especially for 2021, the numbers were substantially faster than long-run rate of growth in GDP. So that long-run rate, again, is a little bit under 3%. And the forecasts that they produced were essentially roughly double that long-run rate in 2021. And then in 2022, ratcheted back a little bit, but overall growth in the neighborhood of 4.5% in both cases. Again, a very strong rate of growth relative to historic norms and relative to the rate of increases that we were seeing pre-pandemic. So I guess I would give you credit if you answered above average growth. So a couple of you might get a point on that, but certainly these were growth rates that got a lot of press for being changed, and actually slashed seems to me to be a big change. It wasn't a big change. And I think that that's really important to keep in mind. We are experiencing disruptions. We do have supply chain issues, but at the end of the day, the economy will continue to grow at a very fast pace, not simply in 2021, but into 2022 as well. Okay, so that's question number 1. Question number 2, I would say that the answer to that should be true. Changes in the consumer price index are best characterized, the recent changes, best characterized as transitory. We will not be, and I'll talk a little bit about this in a couple minutes, We will not be wrestling with big changes in inflation or big changes in the CPI over the course of the next 18 months. We don't think. The data aligns against the idea that these inflation pressures will be a real problem over the long haul. Number 3, what's the best indicator of prospects for future inflation? And the answer to that one would be the monthly percent change in the core CPI. Now that core CPI is, I should have told you this to begin with, but the core CPI, or reminded you, I've probably told you before. Core CPI would be CPI adjusted for volatile prices, food and energy prices. So we take the food and energy prices out of core CPI, or I'm sorry, in the headline CPI to come up with what we call core CPI. And that those core values are less volatile because food and energy are typically very volatile from a price perspective. So generally speaking, we want to look at core to remove volatility, not because we don't think that price increases are important in the food and energy sectors. They're very important. There's no question about that. But including those numbers introduces a lot of noise into the data that makes it harder to interpret. The reason that we want to look at monthly percent changes in core, so the fourth answer is the correct answer. The reason we want to look at monthly rather than year-over-year changes is that the year-over-year data, which is basically the data that we hear reported on in the popular press and in the financial press quite often, those year-over-year changes really have an issue relative to the influence of the base. And so when we look at year-over-year inflation and we talk about 5% inflation at the moment, you have to recognize that 5% is being calculated off of a base that we observed a year ago, which was sort of in the teeth of the pandemic, when economies were shut down and people just weren't spending much money. There was a lot of concern in the marketplace, a lot of concern in the household sector. And so people were being very, very cautious about their spending, and the index, the CPI, was not increasing very quickly at that point. We had a very low index value, and today the index value is about 5% higher. And so over time, say over the next year, we will be comparing next September, for example, this number, not this number, this number to a number that will be a little bit higher, but not a lot. And so the reason that we want to sort of ignore the base when it was basically so low a year ago is that it gives us this false indication that the trends that we have experienced over the last year will be continuing into the future. Okay, and then number 4, in August of this year, the headline unemployment rate was 5.2%. Whole bunch of people dropped out of the labor force. Older people, women dropped out to take care of children, and a bunch of frontline workers, older women and people of color, especially in frontline jobs, dropped out of the labor force. And so if we make that adjustment, actually the headline rate of 5.2% in August or 4.8% in September really does underestimate sort of the size of the dislocation in the labor market. And the correct answer on this question would be 6.9%. 6.9%. And I have to say, we are fairly certain that, a lot of those folks that have dropped out of the labor force will come back into the labor force. As you'll see, that's reflected in our expectation that the unemployment rate will improve going forward, but the rate of improvement that we've seen recently will not be sustained as more people re-enter the labor force. We do not expect everybody that has dropped out of the labor force to come back into the labor force. A really good example of why that's not going to happen is that there were a substantial number of older folks who were very, very close to retirement who essentially decided to go ahead and retire during the pandemic. They weren't planning to. The pandemic accelerated those plans. So the correct answer here is 6.9%. Number 5, what phrase best describes the consumer sector's aggregate balance sheet today? The correct answer is it has never appeared stronger. The last choice, the 5th choice, never appeared stronger. And I'll show you that data, as I always do, in a couple minutes. And then number 6, according to the Financial Health Network, what percent of American adults are financially unwell? Using their rubric, which focuses on 4 key aspects of financial lives: spending, saving, borrowing, and planning. And their rubric has 2 questions for each one of those 4 ideas. The questions, the answers to the questions have been historically triangulated against a database of consumer outcomes. And so they have a really strong statistical relationship between the way people answer the 8 questions in their rubric and historically how, whether people have filed bankruptcy or, gotten into trouble from a financial perspective, defaulted on loans and that kind of thing. And so it's a good historical database that they've triangulated against. And essentially what they do is they take the scores and essentially match them up with the outcomes that they've seen historically. So 66% using their rubric are struggling or just getting by at the moment. It's really an amazing result given this backdrop of consumer balance sheets really never being in better shape. Number 7, the Mortgage Bankers Association forecast basically sees 22 originations declining by 35%. Now, purchase money mortgages will increase and increase pretty dramatically. Really what's driving this is, of course, an expectation that there will be a significantly lower number of refinancings. And then number 8, the IHS market forecast on new car sales has new car sales actually increasing by about 2%. Actually, it might be a little bit closer to 3% in their latest forecast, but a small increase in car sales in 2022. And then, to make it obvious, I assume that it is obvious, but just to put a finer point on both of those questions, mortgages make up about 50% of credit union loans, and automobile loans make up, I think, somewhere in the neighborhood of 30% or thereabouts. So those are the 2 big chunks of business on the loan side of the balance sheet. And then number 9, aggregate U.S. credit union ROA. In the first half of 21, annualized actually came in as the largest positive ROA in the past quarter century. And then number 10, net worth, we believe, will end this year at 10%. Sitting at 10% mid-year, we think it'll be about 10% at the end of this year. And the reason I asked this question is I just wanted to make the point, be sure to make the point, that we expect that the decline in credit union net worth as a result of all of the inflows in savings accounts essentially has ended. And given relatively strong earnings and our expectation of sort of reversion to the mean in terms of savings growth, we would say in 2022, savings will even be higher. And I should say net worth will even be higher. Net worth ratio will be even higher than 10%. So we'll be on the mend in 2022, and essentially the bleeding has stopped from this standpoint at mid-year, essentially. Okay, so those are the answers. And I forget how was this on the honor system?
It's on the honor system, Mike. That's what we did last year.
Honor
And
system.
I think what we
boy.
did was, I think, well, we're credit union people. We're all trustworthy, right?
Well, there's a couple of ne'er-do-wells in the group from what I that I've experienced.
I believe last year you just asked people to indicate in the chat box
Okay,
when you did the typical, everybody who got more than whatever correct or something like that. For those of you who are not familiar with the chat box or have been hesitant to use it before, somewhere around the edge of your screen with this window, whether it's on the bottom or the top, depending on your layout, you have a bunch of little icons. One of them says chat. If you click on that, you should see a chat window pop up, most likely to the right-hand side of your window. And if you just type in the very bottom of that column, it'll be shared with everyone.
and so what we would like people to do is, if anybody, well, nobody scored a perfect 10 because there was one question I think that nobody got right, but if you scored 9 or 10, please indicate that that was the case in the chat. And if you scored 7 or 8, please put your name in now. And in parentheses, if you can, just indicate how many you had correct. If you scored 5 or 6,
You realize we're headed in the direction of 0 here, right?
Yeah.
oh, we have a few 6s.
Because I got 6. Yeah.
Oh, okay. All right.
Great. Okay, so
Oh, the numbers are coming in.
good. All right. So will you keep track of this, Denise?
Yeah.
And I think rather than trying to come up with one winner here,
Yeah, because there's a
We'll
bunch
just-
of 6s.
yeah, we'll have a fantastic prize for everyone who had the highest score. So if there was somebody that ultimately answers, oh, I got a 7, and that's the only person that got the 7, there'll be one fantastic prize for that person. But we always give sort of a runner-up booby prize kind of thing too, right? So we'll keep track of who's got what. And when we return to in person, and that's a little bit of a carrot to get you to come back next year. But when we return to in person, we will have actually 2 ceremonies to celebrate just the incredible amount of gray matter up in northern New England. So thank you for participating in the quiz. I know that it can be somewhat uncomfortable, but I think that the quiz is a good way to kind of hit on some of the most important points that I want to cover as we go through the rest of the presentation. And sometimes I forget to cover the ones that I think are really important. The quiz, I think, had most of what I think is the really impactful stuff. There are 1 or 2 things that just came to my mind that I also want to mention, and I think I'll hit on them in one of the graphics. But so thanks for doing that. And I'm going to now close the chat on my screen, and then I'm going to share my screen. And hopefully you will be able to see.
Yes, we're all seeing your screen, Mike.
Good. Okay.
And just for your information, Mike, in case you didn't catch it, one person reports getting an 11 on your quiz. So obviously your teaching was very effective.
So was that person's first name Ryan by any chance?
Yeah, well, it was his board.
Oh, surprise, surprise. Okay, well, we'll deal with him in a very special way later. So I said at the outset that I'm really excited to be with you today, and I really am. for a bunch of different reasons. And again, I wish we were all there in person, but it is just really amazing to me to have conversations with credit unions today in the wake of this really terrible disruption. And to be able to, talk to you about the impact that you've had in people's lives. And this is one of my recurring themes, as you know, how you touch people, how you change their lives, that's sort of the transformative power of cooperative finance. We don't talk about it enough. We don't brag about it enough. And, I think that members really realize that we do make that difference and they value it. And it does show up in the data. And so before I dive into the economic data, I just want to hit a few points that I think are especially noteworthy. And I think you all ought to give yourselves a collective pat on the back. Okay, so number one, I calculated that in the last year, now I have data at the moment handy that just went through March of 2021. So it's the year ending March 2021. Northern New England credit unions, so all credit unions together in Maine, Vermont, New Hampshire, delivered in the marketplace $330 million in direct and in indirect financial benefits to members and to average consumers in their states. 240 million in total was the result of direct benefits. The fact that you essentially charge less for loans, pay higher savings yields, and essentially impose fewer and lower fees when you do impose fees. $240 million in that one calendar year at a time when consumers were really in need of income, were really in need of financial support, given the level of uncertainty that existed, obviously, in the marketplace. Our academic studies, recall, show that when credit unions are in the marketplace, we've done studies that show that a greater concentration of credit unions in a marketplace results in more benefits to bank customers. So if there are a lot of credit unions in a particular MSA, for example, bank customers really essentially receive much better pricing on both sides of the balance sheet at their banks. And we calculate, using these academic research studies, we calculate that in the year ending March 2021, that bank customers in Northern New England received indirect benefits of $93 million because their for-profit banking institutions behaved in more consumer-friendly ways based on your presence in the marketplace. That is really cool. Okay, number two. Collectively, Northern New England credit unions originated roughly 9,650 PPP loans.
Wow.
$274 million in PPP loans in total in the 3 states. The average loan size of $28,000 and change was about a third of what we saw in the for-profit sector. A direct, I think, a direct indication that credit unions served Main Street mom and pop businesses firmly focused on average folks, not larger institutions, not larger companies, and certainly not Wall Street and national chain restaurants and that kind of thing. This also is borne out in the jobs saved per million in assets lent, where credit unions in Northern New England basically saved 138 jobs per $1 million lent, substantially higher than the 113 jobs per million lent outside of the credit union sector. Very, very impactful. And again, right where we want to be, in that sweet spot, Main Street businesses. This is a terrific narrative that we share almost on a daily basis with policymakers. It resonates, it's impactful, and you ought to really be proud of what you did. Now, 0.91% ROA That's a 30-year high. I have data that goes back handy 30 years. I would say that it's probably safe to say that that might actually be close to a modern day high. But 30 years for the three states combined. And then 0.10%, that is the net charge-off rate annualized in the first half of 2021. Pretty amazing result. So despite the disruptions, despite the challenges, you didn't do what would sort of be the natural reaction. You didn't hunker down and turn people away. You actually did engage in really significant ways, impactful ways, and people appreciated it. It actually shows up in the data. Collectively, Northern New England credit unions increased their memberships by 1.5% in the year ending, the year ending June 2021. That's 5 times higher than the population growth in Northern New England. Maine and New Hampshire are growing their populations, I think, at a rate of about 0.3-ish% per year. Vermont is actually losing population on an annual basis. So 1.5%, I know it doesn't seem like a big number, but it's 5 times higher than the population growth. Really, I think, from an economic perspective, growth is relevance. They recognize what you're doing. They like what you're doing. They appreciate it, and they're voting with their feet. I should also mention, you'll see data, and I'm not going to get through all the data, but you'll see data later on in the deck that that the full year 2020 numbers were even more startlingly high. So it was like 3%, I think, 3% growth in 2020 for overall memberships in Northern New England. So these are great results. You ought to be proud of them. I know it hasn't been easy. Some sleepless nights here and there for sure, but overall, we behaved in ways that we typically behave in downturns. Firmly focused on members, firmly focused on getting people through, and with as little disruption as possible. So that's pretty cool. Okay, we now have to talk about the economy, and I've got about 10 minutes to run through these numbers pretty quickly. So here's our forecast for economic growth. It's actually kind of in line with the IMF forecast and the Goldman Sachs forecast. 6% in 2021, 4.5% in 2022. We've dialed both of those numbers back. You can see that we've also dialed our third quarter expectation, which was originally around, I think, 8%. That was dialed all the way back to 4.5%, and not surprisingly, the Delta variant was the big driver between these sort of recalibrated expectations. The recalibration out into 22, as I alluded to earlier, has more to do with supply chain disruptions and the idea that we forecast sort of the duration of those disruptions. They will be impactful. They will reduce overall growth. But again, 6% growth is roughly double the long run average rate, more than double actually. And 4.5% remains very high relative to those long-term norms. So that's the overall performance of the economy. It really does reflect more and more obvious and more impactful engagement on the part of average consumers. Consumers, after all, account for 70% of U.S. economic activity. So that's a pretty decent growth forecast, I would think, even though it's been recalibrated. Here's our inflation expectations. You can see that we have inflation coming in at 5% this year overall, and then 2.5% in 2022. The 2022 number is, as you more than likely know, much closer to the long run average rate and the rate that the Federal Reserve is comfortable with. And I want to talk to you just a little bit about, where we're coming from in this forecast, because I know that it's at odds with what a lot of people are thinking. So you learned in the test that the probably the best measure of what the future course of inflation is likely to look like, is this idea of the core CPI and changes in the core CPI on a monthly basis. Because again, we take out the base effect of those annual rates. So here you can see that most of the increases, month over month increases in core CPI really showed up in obvious ways in April, May, and June. In July, August, and September, the increases in prices have come down to earth basically, and are in line with, fairly decent increases in prices, but not the kind of increases that we experienced in the second quarter. So this is our starting point. This suggests that going forward, we're not going to continue to see 0.9, 0.7, 0.9, that kind of thing. The increases will likely be quite a bit lower. Now, this is also borne out in a couple of other different ways. One way is that there are a number of forecasts, consensus forecasts out there, blue chip forecast, that kind of thing, of economists who basically opine on what they think is going to happen with inflation. Our forecast here reflects what those consensus forecasts are saying at the moment. The other thing that we look at, and so we're not just hanging our hats on what other economists are saying, and certainly not what the Federal Reserve economists are saying, but we also look to see what the market's implicit forecast is, and for that, as you know, we look at the difference between the 5-year Treasury and the 5-year Treasury inflation protected security yields, or the 10-year and the 10-year TIPS yields. And I haven't looked at those numbers in the last day or so, but the last time I looked, each of those differences in yields come in at about 2.5 to 2.6%, somewhere in that neighborhood, which suggests that over the next 5 to 10 years, people with skin in the game, people in the bond market that are buying and selling these securities, believe that inflation will run at a rate that is very, very close to the long run average, and not anywhere near the elevated rates that we've been seen reported in the last 6 months or so. I should mention that, and the reason I want to mention it is because we economists don't get a lot of credit all the time, but I should mention that the blue chip indicators historically have been more accurate than the market's implicit forecast. But both of those things are lining up at the moment, which I think is really important to point out. So that's CPI. Here's this is an index that's put together that sort of summarizes the views of those consensus forecasts of economists. And you can see that the September numbers really do have CPI increases that are essentially annualized CPI increases that are essentially very, very close to long run averages. And then a point of reference on unemployment rates. The unemployment rate today, as I mentioned earlier, and nationally is 4.8%. And in northern New England, the rates tend to be lower. The Maine unemployment rate is very close to the US average. In Vermont and New Hampshire, those unemployment rates are closer to 3% or thereabouts. And our forecast for the unemployment rate has the unemployment rate staying at about 4.8% throughout maybe not throughout the next couple of months, but ending the year at 4.8%. So not changing from its third quarter value. And 2022, we see the unemployment rate at 4%. So essentially, this forecast is telling us that the unemployment rate by mid-year next year should be somewhere very, very close to full employment using this headline measure of labor market health. So a continuation of the improvements that we've seen recently, not much in the way of an acceleration, and we don't necessarily think the improvement will be a straight line affair. Again, especially because many folks have dropped out of the labor force and some will be coming back in. And so that tends to put upward pressure on these numbers. So don't be surprised to see the numbers sort of vary a little bit over time, but the general trend will be down, obvious improvements. And again, actually an unemployment rate that is a bit lower than full employment by the end of 2022. I should mention that the improvements we're seeing are broad-based. So year over year, unemployment rates have declined in all but about 5 MSAs throughout the country. There are roughly 400 MSAs in the United States. I believe 3 of those MSAs reflected an increase in unemployment rates over the last year. 2 showed no change. Every other MSA showed improvements. Also, I think impactful is the fact that when we look at the labor market, you may recall we track about 18 distinct industrial sectors, I call them sectors of the labor market. And all but 2 of those 18 sectors are actually showing pretty significant gains in employment. The only 2 that showed weakness were the financial services sector, which I believe shed about 3,000 jobs over the last year, and the federal government, which shed, I think, 1,000 jobs. Everywhere else we're seeing growth, and it's generally speaking pretty substantial, significant growth. So I believe that's a really heartening view of what's going on in labor markets and does support this idea that we will continue to see improvement. And of course, those improvements will be sort of the underpinnings of our expectation for decent overall GDP growth. So here's our forecast. I think I'm coming up here on break time. Yes. So here's our economic forecast in a nutshell. This is on our website, www.cuna.org/economics. And again, I didn't go through all the gory details here, but the real important thing I think to draw your attention to is that the reason that we go through this exercise in the first place is that, well, there are a couple of reasons. One, there is a strong correlation between GDP growth and credit union loan growth. So that's important. And there's a strong correlation between the unemployment rate, actually a negative correlation, between the unemployment rate and credit union asset quality, or I should say credit union net charge-offs. It turns out that people that are employed do pay their loans back. So, in terms of the primary drivers of economic activity and the 3 that we're most concerned about, there is that direct relationship between credit union operations and our forecast. But the really important part of the forecast, I think, is, what does all this mean in terms of the behavior of market interest rates? And what I'm about to tell you is that while the headline numbers look great, when you dig down into the details, we have some real concerns about the way forward in the job market, especially, and more generally, in terms of getting people back to normal. It's going to take a while. And so you've heard of this idea of a K-shaped recovery. That's real. And I'm going to show you the data here when we come back from break. But essentially what this forecast is telling us is that the Federal Reserve does have the ability, and they've said they have the willingness, they do have the ability to stand pat, to stand by with low short-term interest rates, supporting economic recovery, not simply until the time that the headline numbers improve, but beyond that point, until we look at the finer level of detail and see obvious improvement in the sectors of the economy that were hit hardest in the downturn. That's going to take longer. And so it's really important that the Fed stays the course. We believe that will be the case. We don't see the Fed funds interest rate moving at all during our forecast horizon, which covers the next 15 months or so. On the other end of the yield curve, we see the 10-year Treasury widening out, but not substantially. We think the 10-year, excuse me, will finish this year at 1.5%, and that will be at about 2% by the end of 2022. And looking at the bottom line of this graphic, you can see that that spread between the 10-year and the Fed funds is essentially going to be widening out based on that forecast. What this means, of course, is for credit unions is that we will continue to pay our depositors rates that are very, very close to zero. On the margin, our asset yields should be widening out just based on changes in interest rates. And so you can see on this bottom line, the second column of numbers, the difference between the 10-year Treasury and the Fed funds was about 85 basis points in 2020. We think it'll be 140-ish basis points this year and almost 2 points in 2022. And so essentially what we're saying is that just based on interest rate movements, we believe that net interest margins in credit union land will be widening out somewhat. Now, the devil is in the details, and all else is not equal. We also have a mix-related effect to talk about. And when we get back from our half-hour break, I will talk a bit about that mix-related effect. But first and foremost, I want to talk to you a little bit about the disruptions that we see amongst average Americans and why we're concerned about those disruptions as we go forward. So I'll pause here. I will look at the chat during the break and see if there are any questions on what I've covered so far. And if so, I will try to cover some of those questions before I dive into the rest of the material when we return.
Yep.
Okay, so I did not see any questions in the chat. Did I miss any, Denise, or?
Nope,
No?
I didn't see any either.
Okay, awesome.
I
So I
do
just
have
wanted to,
Let me ask one quick question. There was a 6 in the chat with the name of Scott, and I got 3 Scotts. So if you can send a chat to me and tell me which one of you are, then we'll include you in the group of 6s. That's all I need to know.
okay. Okay, so I just wanted to spend a little bit of time here quickly to talk about what we're seeing in the consumer sector. And as I said, at a real high level, things look great. So what doesn't look so great, I guess, at a high level is how people are feeling at the moment. And that shows up in this data from the University of Michigan, the Consumer Sentiment Survey, which basically reflects a really significant decline in consumer sentiment in the last survey that they reported from a reading of about 83-ish to about 70. And you can see that reading of 70 is the lowest level of consumer sentiment since the beginning of the COVID crisis, which is a little bit surprising to me. But I guess the really important thing is that, people coming into the last several months were expecting a return to normal, and we didn't get a return to normal. Instead, what we got was a new normal, and this issue that's not going to go away ever in the future, I think. So that has really kind of had a significant impact on the outlook in the consumer sector. The good news, I guess, is that if you look at this data from a broader historical perspective, even a reading of 70.3 is substantially higher than where it was for most of the economic or the financial crisis and the economic disruption related to the financial crisis. So I guess that's good news. My expectation is that as we look forward, this number will actually go up and go up pretty significantly. It bounces around. You can see that throughout this entire period. So again, this won't be like a straight line permanent improvement, I don't think, but it's very clear hospitalizations are going down, infection rates are going down, deaths are going down. And that suggests that, people's attitudes and their outlooks are going to change in a measurable way going forward. But at the moment, this reading of 70 really is reflected in activity in the marketplace and is part of the reason that we dialed back our GDP forecast, and especially in the second and third quarters. Now, the equity markets have been performing really well. And the way that we look at the consumer balance sheet is we choose one really significant financial asset. Here it is, the S&P 500 closed. I have 1011. This was actually yesterday's close, 44.38, if I'm not mistaken. And that puts us really close to the all-time high. We've been bouncing around a little bit, no question about that. But we've been bouncing around near an all-time high for a while. Since the start of 2020, equity markets are up almost 40%. And on average, since 15, they're up by about 14.5% average per year, annually. So this is a really strong showing. As you know, the long run average rate of increase in equities is somewhere in the neighborhood of 8 to 8.5%. So 14.5% is really a strong showing over this, again, multi-year period on average. About 55% of households have an ownership interest in equities. So these are not widely directly held or indirectly held by the public. And certainly the vast majority of the holdings are held by wealthy people. So it is lumpy. There's no question about that. But I would argue that even for folks that don't have an ownership in interest in equities, just seeing these numbers and seeing how well equity markets are performing sends a really direct message about the current state of the U.S. economy and allows people to make inferences about the future state of the U.S. economy. Basically, it affects the way people look at the world, and it affects the way that people think about the future. And so I think at a kind of a visceral level, people see these numbers and see them bounce around near all-time highs, and that makes them feel better than they otherwise would. And it makes them feel probably more secure, and certainly gives them an impression that the business sector in the United States is quite healthy in the scheme of things, despite all of the challenges and disruptions. So I think by extension, that would mean on the margin that people are more likely to be engaged economically, spending money, and actually even spending money on big ticket items, even if they don't have an ownership interest here. So this is really important. The other asset that we look at, the non-financial asset, which is widely held by about 2/3 of households in the United States, of course, is housing. And we've seen really strong growth in house prices in the last year and a half or so. Double-digit increases variously measured in home prices. This is for purchase transactions. And through 2020, you can see north of 10% on both the FHFA and the Case-Shiller index. The more recent data that we have has the FHFA and Case-Shiller coming in at about 20% year over year, July 21. Mid-year data, June data for Maine, New Hampshire, and Vermont are all north of 20% increases. These are very healthy increases. And again, 2/3 of the population has an ownership interest. As with equities, these are not realized gains necessarily for the average person, but they feel wealthier when they see that their home value is going up, whether they're cashing out or not. And so it is really impactful. There's no question about it. Now, as an aside, I should say that I mentioned earlier that the issue of inflation was one of the bigger issues that people ask me about. This is probably the other one. Credit union board members in particular have a very, I would say, strong and accurate memory of what happened during the formation of the real estate bubble in 2004 to 2007. the after effects of that, the financial crisis and the Great Recession. And so not simply board members, but credit union professionals generally are very concerned about whether or not these increases represent a bubble in the housing market. And my thought is that, it kind of depends on how you define bubble. And generally, when I think of an asset bubble, I think of, a situation where prices are increasing pretty significantly in the face of speculative activity. And we're really not seeing speculative activity in the housing market, generally speaking. There, are pockets here and there, but generally speaking, we are not seeing that. And generally speaking, what's driving these increases is not so much demand, but a lack of supply and supply disruptions. The lack of access to skilled labor in the construction arena, so electricians and plumbers and that kind of thing, kind of in short supply. So it's hard for construction contractors to build new homes when they can't get the personnel to actually do the work, and especially the more technical work. And so that part of the supply chain is an issue. And then prices generally have been an issue. Lumber and various raw materials, metals in particular, have shown pretty strong price increase. So all of that is working into the calculus here. And I feel like, these numbers are high, they're unsustainable, but, and I would actually characterize it as a bubble, but I don't necessarily think that it'll be a bubble that pops. I think it'll be a bubble that fizzes because of the nature of it. The other couple of things to keep in mind, of course, are that when we look back to the Great Recession and the causes of the Great Recession, there were a couple things in play then that simply are not in play today. For one, the types of loans that were being made back in 2004 to 2007 are not being made today. It's illegal to make those loans, liar loans and loans that no interest loans. So the kind of risky anti-consumer loans that banks were saddling folks with, those are just not available in the marketplace today. The other part of it, of the equation, of course, has to do with who actually is doing the buying and selling today. Back during the formation of the real estate bubble in 2004 to 2007, a big driver of the increase in mortgage lending was the fact that banks essentially opened their book of business to subprime borrowers. Prior to the beginning of the buildup of the housing bubble, bank mortgage originations to subprime borrowers averaged about 5% of total originations per year. And that put it at about a point or a point and a half above the credit union average. Moving forward through the creation of that bubble, bank originations to subprime borrowers went from about 5% to 25%. Now in credit union land, we stayed right at about 4% or thereabouts throughout the entire buildup of that bubble. But the bankers, of course, what they were doing is they were using these alternative forms of mortgage finance, buyer loans and no interest loans, to qualify lower income people as many as they possibly could, in some cases to allow those people to speculate in the housing market and let others, by the way, speculate in the housing market on that basis, or in large part on that basis. And of course, that led to some not so great results. You know the story. That simply isn't happening today. We have not seen a spike in mortgage originations to subprime borrowers. So for those reasons, I'm not so concerned about this necessarily being a bubble. But I think the essential point here is that it has been generally helpful from the standpoint of consumer or members' balance sheets. So two big assets appreciating pretty significantly makes people feel wealthier, makes them feel better about the future, makes them feel more secure, and that's generally very helpful. Now, on the other side of the balance sheet, here's an update on another graph that I've shown you probably every time we meet. To confirm that we did see this massive acceleration and magnification of pre-existing trends here in terms of exposure to debt in the household sector. The acceleration, of course, was the pre-existing trend of deleveraging in the household sector, which, of course, began in the wake of the Great Recession or financial crisis. So you can see way back then, right before the beginning of the financial crisis, the debt to income ratio in the household sector was almost 125%. It's now down to about 88%. That puts us about where we were way back in 2002. So a general improvement in the sort of exposure to indebtedness. It's also something that makes me feel like we're doing okay in the mortgage market because that whole level, even though home prices have increased dramatically and demand for loans has been mortgage loans have been pretty high, that has not led to a big ballooning in the exposure to indebtedness like we saw during the buildup of the former housing bubble. And then looking at the cash flow aspect of this, you may recall I've previously reported that we were on sort of a downward trend with debt payments, monthly debt payments as a percentage of household income. That's the debt service burden. It's all the way down to 8.23% of take-home pay. So the overall level of debt relative to the overall level of take-home pay in the consumer sector in the United States is less than 10%, has been for a while, but it's now at the lowest level that it has been in recorded history. This is data that the Fed has been collecting since 1980. And that just says to me that, people have a lot more flexibility in their spending and a greater resiliency than they did pre-COVID. It really is amazing what $5 trillion can. So in any case, that's very helpful. And you put those numbers together, assets minus liabilities. Here is the picture for net worth in the consumer sector at an all-time high of nearly 800% of take home. So that's when I say that the consumers have never been in better shape. That's the data that I was thinking about when I asked that question. Now, I did mention that we're seeing sort of dislocations and obvious departures from the conclusions that we draw in those headline numbers. And some of that is shown in this graphic where I've adjusted that headline inflation rate for dropouts. So, taking the folks that have dropped out of the labor force, adding them back into the labor force, and then looking month by month what the labor force looks like relative to what it was pre-COVID, essentially. And you can see that making the adjustment for the most recent set of data that we can adjust, August, there's about a 1.7 percentage point difference between that headline unemployment rate and then adjusting for dropouts. Another way to look at it is by race and ethnicity. And here's the data on overall unemployment. And then here's the data for whites. The overall measure of unemployment peaked out at nearly 15% in April of 2020. For white workers, the peak was 14.1, so a little bit under the overall average. And it stands at 4.5 in August, which was, again, a little bit under the overall average. Now, Blacks and African Americans have had a completely different experience, of course. You can see pre-COVID, they were at about 6%. So that put them at about 2.5 percentage points above the headline rate. Their peak level of unemployment actually came in at 16.7%, which put them at about 2 percentage points, a little bit over, or actually a little bit under 2 percentage points relative to the headline rate. And then you can see today that the headline rate is 5.2%, but the rate amongst Blacks and African Americans is way more than 2 percentage points. It's 8.8%. So it's closer to 3.5 percentage points at the moment. So it was a big disruption for that segment of the workforce, and it has essentially remained a very important and negative outcome in that sector of the labor force. And you can see the same things with Hispanics and Latinos. And of course, one of the driving factors in this data is that Blacks and African Americans and Hispanics and Latinos are more likely to be employed in frontline jobs that have been directly affected by COVID. So again, this gets at this idea of the K-shaped recovery, the Fed needing to be involved and engaged for a longer period of time than what the headline numbers suggest. And there are some other sort of general, I think, observations that come into play as well that you might find helpful. This is the percent of jobs lost during economic downturns. And so this black line here represents what happened in the COVID crisis. Lost about 15% of the jobs. We're about 3.5% down at the moment. This gives you context with the Great Recession, where, you know, at most we lost 6.3% of the jobs. It took a long time for those jobs to come back. And then this is leisure and hospitality. So this is restaurants and hotels and theme parks and that kind of thing. And you can see in the COVID crisis, almost half those jobs were lost. And at the moment, even though the overall market has performed quite well, that segment of the market is still reflecting 10% fewer employees than pre-COVID levels. And so this really, I mean, is a more negative result than we saw in the aggregate during the Great Recession. So again, this suggests that the improvements, while they'll be real and they'll be obvious, and they're coming up in the not too distant future, that they do hide what's going on in certain segments of the market that are particularly vulnerable. So this is the data from the Financial Health Network, and I said 66% in the test because it was a nice round number, but 67% is what they're reporting in terms of adults living in America who are financially unwell. I just wanted to draw your attention to the fact that the most recent data that they have, or their pulse survey late in 2020, shows that the disparities that we see by gender, by income, and race and ethnicity, and that we have seen for long periods of time, actually widened out in the COVID crisis. And that was particularly true amongst the disparities we see by income and race and ethnicity, where you can see, for example, on the income metric, only 40% of those making $100,000 or more are financially unhealthy. 89% of those making $30,000 or less, which includes retirees, some of whom are very, very wealthy. But 89% of those folks are financially unhealthy, according to the Financial Health Network. And actually, I'll pause there. I have not talked in the past about sort of my role with some of this data, I don't think. And so I just wanted to make that clear to folks. One of the things that I'm doing my side job now at CUNA, which has actually turned into more of a full-time job, is to work with this data to try to tell a better story and to make policymakers aware of what credit unions are doing to help with this issue. And having mentioned credit unions there, I should probably also mention that our data, according to the Financial Health Network, is not much better than the national average. So 67% financially unhealthy nationally. Amongst credit union members, that number is lower, but it's still north of 60%. It comes in at about 63%. So in any case, my role is to help try to put some numbers and narrative together to try to make it obvious to policymakers that credit unions really are making a difference in people's lives. So we have this financial well-being for all project that we're engaged in. And I think I said earlier that the purpose of the project is basically to make sure the trade association is aligned with what you do, with your purpose for being, you know, and obviously you may not have the words financial well-being and financial well-being for all in your governance documents, but I'll bet you if you look in those governance documents, you will find something that's related to what I would consider to be archaic language from the original Federal Credit Union Act, basically, which spells out a mission of essentially serving people of modest means on the one hand, and more broadly, existing to provide credit for provident purposes and access to access to thrift, basically, savings accounts. That's what you're all about. It appears in your governance documents. We interpret that to mean financial well-being. We're just trying to make sure that, our conversations generally and the data that we bring to the table from an advocacy perspective, in particular, is more impactful and more aligned with what you do on a daily basis. So that's part of the reason I like to look very closely at these numbers. I will pause there. Are there any questions? I will look at the chat. Okay, I don't see any questions in the chat. So I'll just continue for a couple minutes and we'll talk a little bit about the credit union outlook. I did, as Denise noted, I did provide some profile reports for each state. I've collapsed the 3 states into northern New England, and that data is included in this PowerPoint handout. So the starting point here is to confirm that the consolidation trends that we've been seeing for many, many years are still visible. The number of credit unions is still declining, but the overall number has not been significant over the last several years, and especially so in northern New England. Now, having said that, I will also say that historically, we have seen very few, relatively speaking, very few credit union mergers and credit union failures during the middle of economic crisis. What tends to happen, especially with voluntary mergers, is that they accelerate at the conclusion of economic downturns, and that shouldn't be a surprise to anybody. During hard times, most credit unions are strapped, so resources are thin, and also, of course, the focus becomes less on growing the business and more on maintaining, and you're more inward focused essentially. So we expect nationally that we don't put finer detail on these projections, but we would expect nationally for a pretty significant acceleration in consolidation. And again, the numbers may not jump off the charts, but the percentage changes more than likely will be obvious and more impactful than the decline in the numbers. So in any case, you can see that on the right-hand side of this graphic, this, I'm sure, that most credit unions are small. In fact, the median asset size nationally is about $47 million or so. So the bars, when you see these asset category bars, just remember the first 2 bars represent half of the movement and the rest of them the other half, okay? And I think the 100 million cut point is about 2/3 of the movement, if I'm not mistaken. So in any case, we're seeing that consolidation. We expect more of it going forward. Here are the membership growth rates that I showed you earlier. It's hard to see the number, but for the 250 to 500 million asset category, I believe that's 11%. So a really strong result there. Maybe a function of, I didn't have a chance to look at, but maybe a function of a merger. In any case, it would have to be like a merger of equals or a number of mergers from the smaller asset size categories. Or it could just be a data input error. In any case, that profile is essentially telling you that larger institutions, generally speaking, record the fastest membership growth. That should come as no surprise, especially during the COVID crisis, because there are many small credit unions that simply are not involved in the first mortgage arena and that don't play in the business lending or commercial lending sandbox either. And mortgage lending, first mortgage lending, and mostly via refinancings, and PPP lending and commercial lending generally, really were the drivers of credit union loan growth during the last year and a half. Okay, so that's partly reflected in these numbers. Okay, so our outlook for credit unions, recovering, not recovered, probably the last time I spoke with you, I maybe used those same words to describe what's going on in credit union land and what our outlook is for the way forward. We believe that the credit union outlook essentially will mirror the developments in the employment market. So I described the labor market improving in obvious ways, but not evenly. And so that's, I think, what will more than likely happen with credit unions as well. And the recovery will not be, all signed, sealed, and delivered by the end of this year, nor by the end of next year. When we meet next year, I'll bet you may not be thinking this about your credit union, but in general, credit unions nationally will still be in the process of recovering and will not have recovered all the way from the COVID crisis. So on the savings side of the book, we expect most of what flowed in, both in 20 and 21, to stick around. There has never been one year in credit union history, and we've got data going all the way back to, I think, 1934 or thereabouts. There's never been a year where credit union savings balances have declined. We think it's unlikely that they'll decline in 21 or in 22. Going forward, we do not expect people to basically spend down all of the savings that flowed in due to federal stimulus payments and unemployment benefits and all that kind of thing. We believe that that consumers were hit hard. They have long memories. They certainly appreciated the fact that $5 trillion in federal stimulus did make a difference and that did come into their accounts. And going forward, there remains a great deal of uncertainty, not just from an economic perspective, but from the public health perspective and the perspective of the future course of COVID variants and so forth. And for that reason, we expect rainy day funds that were built up over the last couple of years. Recall that savings growth was about 20% last year, probably going to come in at about 12 or 13% this year. That's really strong growth. We expect revision to the mean in 2022. So that would put savings growth at about 5 or 6%, actually a little lower than the mean as we go forward. Now, on the loan side of the balance sheet, we do believe that there will be an acceleration of loans. Overall loan growth is going to be pretty tepid this year, though, especially given the backdrop of 6% anticipated overall GDP growth. We think that credit union loan balances probably grow by about 6%, somewhere between 5 and 6% this year, probably closer to 6. And then in 2022, again, a reversion to the mean where we'll be expecting somewhere in the neighborhood of about a 9% increase in loan balances. And so if you put those two things together, essentially what you have is a continuation of lots of liquidity sloshing around in the system, very low loan to share ratios. And I guess it's great on the one hand to have a lot of liquidity when you're in the middle of a crisis, but it's also possible to have too much liquidity. And I think most people would agree at the moment we have way too much liquidity. So those loan to share ratios will remain low. They'll probably start to head up next year based on the forecast I just gave you, but they will remain low and substantially lower than they have been in the recent past. So, and by that, I mean, we'll probably bottom out at levels that are very close to what we saw during the Great Recession. Finally, or I shouldn't say finally, but a couple of other things to mention. There's one of the big questions on the credit union operational side of the equation has been, what does the back end of this thing look like? Are we going to see a big spike in delinquencies or a big spike in loan defaults, more importantly? And our guess is that we will not see that spike. And I think the driving reason behind that is the improvement in labor markets has been pretty dramatic and will continue going forward to be developing at a pace that is faster than what we've experienced in previous downturns. So incomes are going up, and they're going up strongly, as you know, and they will continue to do so as the economy expands. And essentially that suggests to us that, yeah, we're going to probably see some modest increases in defaults, but nothing that would really raise any red flags. Fourth, the earnings rate, of which I talked about earlier, was very, very high from a historical perspective. But we do think that earnings challenges are going to be obvious, and especially for a lot of smaller credit unions. The good news for the smaller credit unions is that basically the erosion of their loan portfolio that occurred as mortgages were refinanced is likely to slow down and more actually likely to stop. And we will see pretty significant growth outside of mortgage and commercial lending portfolios going forward. If I had to guess, I would say, automobile loan portfolios that are growing at rates somewhere in the neighborhood of 3 to 5%. And then next year in that general vicinity as well. And again, those rates are higher than recent rates, especially in the new car arena, but they are constrained relative to what we would expect in an expansion because of the supply chain issues and the idea that those supply chain issues will be with us for at least another 6 months. And then finally, as I mentioned, we think capital is going to end the year at about 10%. That brings it down about a point and a half relative to pre-COVID levels. Now, you may recall, I think the decline was about 2.5 points, maybe 2 3/4 points during the Great Recession. So this won't be as severe of a decline, but it did take 10 years for net worth ratios to get to their pre-recession peaks in the wake of the Great Recession. And because we acquire capital through retained earnings, and in the absence, if we're correct, in the absence of declines in assets, it's going to take a while to get those, or the declines in savings, I should say. It's going to take a while for those capital ratios to get back up to pre-COVID levels. So again, I'm going to pause there for a moment to see if there are, no, I don't see any questions in the chat. So then I'm just going to quickly run through some of the data points. This is showing you overall loan growth and savings growth at credit unions. Again, we expect savings growth to come in at 12% this year. The mid-year year-over-year number was 23%. And so, I just want to point out that's the numbers that you're seeing are not going to be maintained throughout the rest of the year. So 12% seems like a reasonable number based on the monthly estimates reports that we put together using an abbreviated version of the call report that credit unions give us. So 12 and 6 on savings growth, 6 and 9 on loan growth. Maybe not, like, strictly speaking, a reversion to the mean, but a reversion to a more normal level of loan and savings growth and a more normal relationship of loan growth outpacing savings growth. Well, the growth trends that we see in Northern New England really mirror these trends. Now you can see, I was talking earlier about how small institutions didn't do PPPs for the most part, don't do commercial lending. Large percentages of them are not engaged in those businesses. And because of that, when mortgages refinanced, a lot of the loans that were on small credit union balance sheets got sucked into the refinanced paper, either at other credit unions or at banks. And so you can see here in the smallest asset category, loan growth coming in at negative 1.1%, just eking out a small increase, 0.8% in the year-over-year data for the 20 to 50 million group. And again, those represent in combination, those two groups of credit unions nationally represent about 50% of all credit unions. So, but this is a picture for Northern New England. And then I'm going to skip through this. Well, it basically shows you the increases that we've seen. I talked earlier about commercial loans and first mortgages driving loan growth. Used automobiles were in the mix as well. They expanded by about 6.5%. But new autos actually, in the most recent data, year over year have experienced almost a half a point decline in balances overall. So a couple thoughts on what the future holds. This was maybe I guess this was in the test. IHS Markit has 4.1% growth in 21 and 2.6% growth in overall sales. Now, this is not increases in balances outstanding at credit unions, but this is for new car sales. And again, pretty tepid growth rates in those sales. You can see the national numbers on the in the bars here. If these forecasts are correct, we're going to have a value in terms of millions of units of about 15.5 million in the aggregate nationally sold. And that keeps us at a level that's well below sort of the normal average rate of sales of cars and light trucks, which comes in at about 17.25 million, at least in the current environment, given current population and the current age of the fleet that's out there in the market today, which is, by the way, sitting at an all-time high. So 2.6% next year. The mortgage originations, you can see I've applied the declines from the Mortgage Bankers Association to the credit union book of business. In 2020, credit unions originated a all-time record by far of $291 billion in first mortgages. There was a ton of refinancing activity. We think in 2021, based on the MBA's forecast, we're going to come in at about 275 billion, and then back to earth with about 180 billion or so in total first mortgage originations in 2022. That would put us at a level that would be modestly higher than the result in 2019 pre-COVID, but substantially off what we've experienced the last couple of years. And then here are the delinquency rates nationally, and then the net charge-off rates. You can see delinquency rates of 45 basis points. We have those widening out to about 65 basis points this year, 60 basis points next year. The net charge-off rates at 0.27%, unprecedented low, never been seen before in modern history, let's put it that way. We have those increasing modestly by year end, and then hitting about 50 basis points in 2022. So although that represents a doubling relative to the data in the first half of annualized in 2021, it is a number that it's actually a little bit lower than pre-COVID levels. And in the grand scheme of things, from a broad historical perspective, a number that I think most credit unions would be happy to see over the long haul. So that's asset quality, and even higher in northern New England, meaning lower delinquency rates and lower net charge-off rates. You can see the overall numbers. The net charge-off rate is not 27 basis points, it's 10 basis points, and the delinquency rate is only 20.28%. So really impactful developments from the standpoint of asset quality. Again, the federal fiscal support has a ton to do with this, as you know. Liquidity risk is quite low, as I mentioned, but the loan to share ratio is at 70%, and we see it at about 72% in 2022. So what this is essentially telling you is that we think that the growth that's going to be occurring in assets is basically going to be occurring mostly in low yielding investment accounts. And so that's why when I was talking about interest rate movements and how there's more than likely going to be supportive and helpful of credit, in terms of boosting credit union net interest margins, that when all is said and done, this mix related effect is going to be really powerful. And so the fact that loan growth is going to still be pretty low is going to mean that a lot of the growth that's occurring will be in investment portfolios, not in loan portfolios. And even to the extent we see growth in loan portfolios, my fear is that a lot of the paper that will be rolling off the books will be rolling off at higher yields than what new production can be seen as a replacement. So maybe not so great news on the net interest margin front based on those ideas. And here are the loan to savings ratios in northern New England, a bit higher than what we see nationally. So that's helpful for you. And again, wide disparities by credit union asset size, with smaller institutions being, some of them being very close to 50% loan to saving ratio. And interest rate risk exposure has been increasing, but only modestly, came in at 36%. This is long-term assets as a percentage of total assets. Not the best measure of interest rate risk, but one that NCUA uses a lot. Recall that this measure of interest rate risk includes commercial loans. Those are deemed to be long-term loans. I'm not sure why, but those represent about 10% of the loan portfolio overall. So there's that. Here's the interest rate risk exposure in northern New England, a bit higher. My recollection is that you all do a little bit more in the way of mortgage lending than we see nationally, and it looked to me like you've been holding relatively higher levels of those longer-term mortgages. And then let's see here, credit union earnings came in at 111 basis points mid-year annualized. So that's the first 6 months of the year annualized. You can see, again, that's a really high number based on recent history. We think at the end of the year, we're going to come in at 95 basis points and then 70 basis points next year. The trends in New England are fairly similar. Larger shops are the most successful from an earnings perspective. Again, given revenue diversification, not very surprising. And then here's the detailed data on the change from full year 20 to first half 21 annualized, where we jumped from 70 basis points ROA to 111. That jump occurred because largely because loss provisions
to process the application.
changed. Somebody's not on mute.
Travis?
Could you mute?
Travis, can you mute yourself, please?
So in any case, so we're forecasting a 41 basis point, or there was a 41 basis point increase in ROA in 2021. The question should be, is this sustainable? Is it maintainable? And I think the short answer is no, that it's not. The 41 basis point increase was largely driven by right-sizing allowance accounts. So allowance provisions declined from 50 to 7 basis points, comparing full year 2020 to the first half annualized. And then also operating expenses declined pretty significantly, though that benefit though was largely offset by a 26 basis point decline in net interest margin. So as we think about the future, a bunch of things that some of which I've already mentioned, but a bunch of things come into mind that lead us to conclude that ROA will, while it will be at healthy levels, will not be maintained at 111 basis points or anything close to that. And in fact, that there might be actual challenges to maintaining the 70 basis point ROA that we saw in 2020. So I talked a little bit about the net interest margin part of that equation. We are concerned about declining net interest margin given not the rate, but the mix related effects that we expect to see going forward. There will definitely be a lot fewer gains on mortgage sales. And we also see threats to ODP and NSF fees, threats to, as you know, interchange income related to credit card transactions. And then this issue with HR and talent management, attracting and retaining qualified employees has become very, very difficult. Many companies outside of the credit union arena, as you know, are basically offering, hiring bonuses, signing bonuses. Most credit unions that I'm aware of are not doing that at this point. Wages are rising and rising very quickly, not simply the average, but in an effort to attract employees, employers are really, those that traditionally paid minimum wage are paying well above minimum wage. So all of those pressures, and they're not simply on the take-home pay, obviously, they're also on benefits as well, and most especially on healthcare benefits. Those will become more obvious as we go forward. And the pressures that are there will be less likely to be hidden by strong asset growth. On the issue of loss provisions, I would say at the moment, this idea of right-sizing allowance accounts has been pretty impactful, especially from a bottom line perspective. But if you look at the run of loan loss coverage ratios, you can see that even at mid-year 21, ALLL as a percentage of charge-offs was substantially higher than that ratio was in 2019. So we saw about a 1.5-year coverage ratio, allowance account dollars equal to about 1.5 times the dollars that were charged off in that year. And that increased to 2.5 times charge-offs in 2020 and 3.7 times, as I said, by mid-year. So that's a strongly elevated coverage ratio as we enter a period of time where the economy will be healing and growing, and people will be more likely, more able to pay their loans off than in the past. It's certainly conceivable that we will see for the rest of this year some loan loss provisioning that is quite low, but that will run its course in a pretty short period of time, we think. So that's it from the standpoint of the ROA, and here are the net worth projections, 10 and 10.2%. And then what we're seeing in northern New England, again, very, very similar to the national averages, especially the trends. So that is my story, and I'm going to stick to it. I see that there's something in the chat. I'll just look to see that. Oh, okay. So what is my position on originating and holding long-term assets given the low loan to share ratio? You're not going to like my answer, but my answer is it kind of depends. And it really depends on each individual institution and the extent to which institutions can adequately, effectively, and from a oversight perspective, measure, monitor, and control interest rate risk. So not everybody has the same tools at their disposal. Not everybody is a member of the various liquidity sources that are out there at the moment. And having those long-term assets, of course, does present some pretty significant risk. I should say, though, that the overall level of exposure has not changed a lot in the recent past. Although we are seeing an increase, and that increase is related to longer term asset holdings for the most part. So, I'm all about the what if and what the results of your modeling suggest will happen in various economic environments. And I would definitely use my forecast, if I were doing this, as a starting point for what the future might look like. And here I'm getting away from, the obvious plus minus 100, 200, 300 basis point thing. But, if I were to be forecasting for what the future holds, I would start with my forecast, but I would have a lot of variation in that result and a lot of variation in the assumptions that I put into my modeling before I could come up with an answer of, just how comfortable I would be with an increase in long-term asset. So it depends on your starting point. It depends on your expertise, tools that you have at your disposal, and your overall comfort level with risk. It also depends on, I think for some people will depend on, how much they're willing to argue with supervisory authorities. I do think it's an argument that's worth making, and you can effectively make it. But the other part of that, obviously, is that no matter what you do, document all of the stuff that you've done, document the what ifs that you've done specifically related to the increase in the decision to increase longer term assets. So probably not exactly the answer you wanted to hear, but best one I have at the moment.
Mm-hmm. All right. I don't see any other questions. Do you?
No,
Nope. All
I
right.
don't.
Okay.
Well, thank
what-
you all so much for having me. I really appreciate it. It's a little weird doing these Zoom presentations. You can tell I'm, not as enthusiastic as I normally am, but it's not because I'm not passionate about credit unions or your results. I definitely am. It's just the medium kind of takes over as I go along. So
That's right.
thanks
Well,
again for having me. I really appreciate it, and I hope to see you all in person soon.
Thank you so much, Mike. And I plan on next year being live, hopefully.
Great.
Take care. Thank you,
Take care.
everybody. Have a great weekend, everybody.
Take care.